Once again, good morning, everyone. My name is Dr. Patrick Ejumedia, Head of Research at SAMTU. First off, I would want to apologize to everyone for the delay. Sometimes we had a bit of glitch in the system that we are trying to use, and that's what took us a bit of time. But we are starting straight away without wasting time. So, a very good morning to my distinguished guests, our clients, partners, and participants of this webinar. For those joining us for the first time, SAMTU is an asset management company with subsidiaries spanning across trusteeship, registrar, assets and fund management, financial advisory, and stockbroking. The webinar that we're organizing today is part of our broad knowledge sharing and market engagement series aimed at deepening understanding of economic reform and equipping investors with insight to navigate emerging opportunities in the financial market. On behalf of SAMTU, I warmly welcome you to today's webinar titled From Reform to Resilience, Positioning Portfolio for the Next Growth Phase. We are delighted to have you join us as we examine the evolving economic landscape, the impact of ongoing reforms, and the opportunities available for investors and portfolio managers in the next phase of growth. Today's session promises to be insightful and engaging, as our speaker will provide valuable perspective on navigating uncertainty, identifying investment opportunities, and building resilient portfolios in a changing market environment. Once again, I want to thank you for taking the time to be part of this conversation, and we look forward to a productive session. Before we proceed, before we go on, I want to ask if we can hear me. If you can hear me, you can just signify by doing a thumbs up at the background so we can then continue. So I'll need the thumbs up to show that you can hear me. Great. Okay, so we are good. Okay, so it's good to know that you can hear me. So we'll be starting the webinar straight away. We've taken so much of your time. It is our time, it's our culture in SAMTU to ensure that we start our event on time and to finish within the stipulated time. So what has happened today is just a glitch on the system, but it's not our culture. So what we want to try to do now is to ensure that we finish within this time allocated for this webinar. Our plan is to do this webinar from 11 p.m. to 1 p.m. so that we can all go back to our respective desk. Before we start fully, we need to put up some guidelines that would guide the process of this webinar. It is important that, that we share a few guidelines to ensure smooth and engaging session. To do that, we want to ask all participants, everyone that is currently on this call, to please keep your microphone muted throughout the webinar to minimize background noise. We want to also ask participants, we want to encourage participants to submit questions using the chat or Q&A box during the session. We will address as many questions as possible during the interactive segment. The webinar is being recorded, and materials will be shared with participants after the session. Should anyone experience technical difficulty during the session, we would want to ask such person to kindly reconnect using the same link or notify support team through the chat box. So, to start with, since the year 2023, Nigeria has embarked on several economic reforms. The notable ones that we have identified are the removal of fuel subsidy, foreign exchange market liberalization, monetary policy tightening, the just concluded banking sector reform, and the ongoing insurance sector reform. There's also the fiscal reform that we have seen, and there are also some measures that are aimed at improving investors' confidence and revenue mobilization. While these reforms initially created adjustment pressure across the economy, I mean, at some point, we saw inflation got into its highest point of around 34%. We saw exchange rates, the black market, your parallel market exchange rate getting to as high as 1,900 and the official market hovering over 1,600 to US dollar. They are gradually laying foundation for macroeconomic stability, except for the ongoing war that we are seeing between US and Iran. We have seen inflation coming down from as high as 34% that it was in December 2024 to 15.06. So it is the advent of the war or the tension, the geopolitical tension that we have seen that has brought some form of renewed kind of inflation that we are seeing now. Again, we have also seen exchange rates, though it is still trying to find its value, its true position, its true value. We've seen a huge form of stability in the exchange rate. We've also seen that the level of speculation in the exchange rate has reduced significantly. We've also seen improved policy credibility, stronger external reserve, increased market liquidity, and renewed investors' interest. Today, the conversation is gradually shifting from reform implementation to economic resilience. And the discussion that we are getting as of today is how businesses, investors, institutions can position themselves to adapt, withstand volatility, and benefit from the next phase of sustainable growth. This transition is reflected in improving macroeconomic indicators, strong market confidence, renewed capital market activity, and increased opportunity across key sectors of the economy. The key question, therefore, now is not only how reforms are being implemented, but how investors can strategically position their portfolios to benefit from the next phase of growth. It is against this backdrop that today's discussion is designed to provide clarity on how this macroeconomic and policy shifts are influencing investment strategy. We will be exploring how investors can reposition portfolio to not only preserve value, but also strategically capture upside opportunity emerging from ongoing reforms. To guide us through this conversation, we are privileged to have an experienced and insightful speaker who brings deep expertise in macroeconomic analysis, capital markets, and investment strategy. His perspective will be valuable in helping us connect policy direction with practical portfolio positioning in this evolving environment. Ladies and gentlemen, please join me to introduce our speaker, Professor Abiodun Adedipe, who is going to be making the presentation. But before he does that, I would just want to give a brief citation of the speaker. Professor Adedipe is a distinguished Nigerian economist and corporate finance expert with over 44 years of experience across academic, banking, consulting, and public policy. He is the founder of Bar Consults, a leading economic and financial advisory firm serving public and private clients in Nigeria and beyond. He earns a first-class degree in economics from Obafemi Awolowo University in 1980 and a PhD in economics specializing in corporate finance from the University of Lagos in 1989. Professor Adedipe's professional journey includes teaching at the University of Lagos, senior role in the banking sector, and leadership in national economic strategy, including contribution to the CBN Financial Sector Strategy 2020 and Nigeria's cashless policy. He has served on presidential committee and as a senior economic advisor to the president, financial sector development, as well as held key roles within the Nigerian Economic Summit Group, that's the NESG. He currently serves in diverse leadership capacity at the Chartered Institute of Directors of Nigeria, CIOD, and the Chartered Institute of Bankers of Nigeria, CIBN. He is a fellow of several prestigious institutes and a recipient of multiple academic and professional awards. A professor of practice at James Hope University, and he sits on a couple of boards of profit-seeking and non-for-profit organizations as chairman, independent, and non-executive director. Ladies and gentlemen, please welcome Professor Abiodun Adedipe. Prof, sir, good morning, sir.
A very good morning to you, my brother Patrick. Thank you so very much for having me here, and also to the distinguished ladies and gentlemen in the audience. And I also appreciate the my profile that you read. I was almost like, is that really me? You know. But thank you very much. And of course, as I've been briefed, we want to ensure we manage our time effectively, which of course our host here also mentioned earlier. So what I will do essentially is share on the screen my slide deck, speak to selected ones among them that I believe are core to the topic, which is from reforms to resilience. And now we can take advantage of opportunities in the midst of what some people will see to be troubles. And then how do we enhance the value that we can generate for ourselves or our institutions, as the case may be. So, but of course, something will make the slide deck available to you after the event. So I will share my slides now on the screen, and then we take the discussion. So thank you all so very much. Okay, yeah, this is it. So once I do that, I will turn off my video so that we can pay more attention to the slides. Let me turn off my video first so that we can have a common view of the slides. Okay. All right. So again, as a reminder, the title of this discussion is From Reform to Resilience, Positioning Portfolios for the Next Growth Phase. So my approach to it is, first of all, to underscore what I call the perspectives. And that is, conceptually, when you talk about from reform to resilience, you are placing emphasis on deliberate and strategic changes to enhance the health and sustainability of society. That's a very broad term. But you can bring it home to your own organization or institution in this matter. And I normally put it this way, that whatever the situation may be, there's a question every strategic leader should be asking. And that question is, what needs to change? So for me, typically, when an economy or corporate entity is in crisis, either a crisis that is disruption induced or the one self-inflicted by the kind of choices they made in the past, I normally recommend sequencing the way out as a bouquet of initiatives that fall in three pillars. The first pillar is survival, which speaks to what must you do in order to survive that crisis. Then once you establish survival, you move to the next pillar, which is what are those initiatives you must execute in order to achieve stability. And then the third one now, I call it growth restart, which means you will now restart growth. So again, each of them having specific things you need to do in order to move to growth. Now, some 6 years ago, we all became familiar with the acronym VUCA, representing volatility, uncertainty, complexity, and ambiguity, which of course was brought to our consciousness by the COVID-19 pandemic. Of course, pandemic, it became in March 2020. And so we began to talk about this as the new normal. But then there was a question we asked my firm at the time. Some 6 years ago, we said, if VUCA is the new normal, what then will be the next normal? Of course, we didn't need to look so far. By 2025, the next normal came on us. And we now call that BANI, all right? Which means the environment we operate and invest in today is brittle. That means it is so breakable. One little, message sent out from through social, handle of somebody can cause disruption that affects everybody around the world. And of course, anxious means every day we wake up, we have no clear idea of what may happen next. Different leaders around the world with their different worldviews, choices, and actions. Then non-linear means if you're an investor, and let's say your portfolio mimicked the performance of the Nigerian equities market in 2025, they must have achieved 51.19% return on your investment. So the question now is, if you repeat the same things you did last year, you have no guarantee that will produce the same outcome. We then say that the world we live in now is more and more non-linear, which means what we did yesterday that produced today's results may not necessarily, if we repeat, bring similar results this year or next year. Incomprehensible. Things are getting more convoluted. And of course, you need to now go an extra mile, which is what something is doing happily for us today. That we need to attend situations like this where we all rub minds and share opinions. In fact, one thing I learned in 2020 from the COVID-19 pandemic was the fact that when we are in a crisis, nobody is an expert. And how did I come to that? I was invited to do a webinar just like this by the Nigerian Deposit Insurance Corporation, the sister regulator of Central Bank of Nigeria. They said, please, we want you to dimension this COVID-19, how it is affecting the global economy, how it is affecting individual economies. Then bring it home to Nigeria. How will it affect the Nigerian economy? And then from there, how now will it affect the Nigerian banking industry? And then bring it home to us. How will it now affect deposit insurance in Nigeria? So I thought it was well defined. So I went prepared. Getting to the webinar like I am with you now, I discovered that there were 54 countries represented at the webinar. 54 countries, including the US, that's their FDIC, and then Canada, Australia, everywhere around the world, 54 countries. So I now told myself, so that means that in my little corner here in my house in Lagos, Nigeria, I was going to speak on a subject that every leader of insurance deposit insurance in banking all over the world was coming to listen to me. What will he say? What can we learn? And I thought, oh, okay, so that means when we're in a crisis, therefore, it means nobody is an expert. So that's why we have this word here, incomprehensible. So to make sense of what is happening, we need to look at it from different perspectives, different angles. And like I told my friend here, Dr. Patrick Ejimudia this morning, that when we have discussions of this nature, it is about, let's stay with data as professionals. So we cannot afford the data we are looking at because that's what the market is saying. But we may have different interpretations of that data. So we can define interpretation. But ladies and gentlemen, I can't fault you in terms of your thinking about the data. Neither can you fault me or label me as being political. It's about the way we interpret things that will also inform the actions we take thereafter. Now, Robert Kiyosaki is the author of that popular book, Rich Dad, Poor Dad. He said, for every benefit, there is a risk. And for every risk, there is an opportunity. So I will circle back to this with a simple statement I made at the end of my presentation. Now, if you look at equities generally anywhere you are in the world, equities provide growth, okay? What do bonds offer? Bonds offer stability, and together they help portfolios weather different market environment, that is storms. But what are the drivers of the prices of stocks? What drives the yield on bonds or even the price of bonds? Now, we know that stock prices are driven by future earnings. which means a stock that its price is going up is an interpretation by the market participants that that stock will produce stronger earnings in future. So if there's any question mark on future earnings, that stock will be marked lower in terms of price. But when it comes to bonds, what drives bonds primarily are nominal cash flows, which means this particular sovereign issued a bond. Let's look at their fiscal, activities. Do they have capacity to generate the cash flows that will extinguish the half-yearly coupons they pay, and then to extinguish this bond at maturity? If it is so, investors rush into that particular instrument. Now, geopolitical stress, which Dr. Ejimote mentioned earlier on, like the ongoing Gulf conflict, can test that relationship between stock prices and future earnings, and the relationship between bonds and nominal cash flows. So resilience then, and this comes back to you, resilience can be built into your portfolio by adding commodities. That means instead of having equities, bonds, fixed income securities, rates, that's real estate, insurance, trust. Okay, we talk about them also later. Now, the reason is if you add commodities to your portfolio, yes, in general, we say you are diversifying it, but you also diversify strategically. And the reason is because commodity prices generally and historically are driven by disruptions. For example, first quarter of this year, an ounce of gold crossed the historical level of $5,000. That was the first time gold crossed that particular band. It happened in the first quarter of this year, crossing $5,000 to an ounce. Okay, why has it been so? It has been driven by the disruptions caused, of course, by Trump 2.0, as we call him. I mean, you understand what I mean by that. There is Trump 1.0, first coming of Trump. We saw some little bit of erratic choices, but Trump 2.0 is a lot more erratic and disruptive. Okay, but apart from disruptions driving commodity prices, there is also real economic demand. Take, for example, the demand for gold is going up, not because of only disruptions, but several central reserve banks all around the world, in the light of what they see Trump doing, and of course, the issues around the value of the US dollar. All right. In fact, if you look at the chart, I didn't include that in my slides anyway, but there's a chart that shows you the dollar index in the last 5 years. And we see clearly there that dollar has been softening a little bit in the last 2 years thereabout. So now, if you look at that, you then tell yourself that, look, shouldn't we as central reserve banks begin to take a look again at our portfolio of instruments in the reserve? And so many of them, and this is not peculiar to Nigeria, all around the world, many of them are now investing in gold. So the demand for gold has increased because central reserve banks are now loading up. In Nigeria, for example, the Central Bank of Nigeria has over $2 billion worth of gold in its portfolio. Okay, so that is just to illustrate. Now, what are the evolving macroeconomic and social issues? And I put this as a premise. The central theme today, which of course was mentioned earlier by our host, the US-Israel war on Iran. That's my description, not with, on Iran. Okay, today is the 74th day of that conflict. And there is, as of today, no clear indication of when it will end. So now, why would I say that as an analyst? The narrative has been shifting since the war began. On 28th of February, first week of the war, Trump went to his Truth, social handle and sent out, we won. That's week 1. Then week 2, he sent out another post. We are winning. And of course, we know the difference between we won and we are winning. Then week 3, he again sent out the message, we need help. Then he started pursuing the members of NATO that he had rubbished earlier on. And all of them turned their back on him. Of course, thereafter, silence. More recently, said, well, we are not doing, there's no more hostility in Iran. And of course, on the other hand, just 2 days ago, he said, well, I'm not happy with the way Iran is taking this negotiation. And if they don't change the way they are doing it, we will go to war again. So the price of crude oil have been moving like the jingle of a bell, okay, up and down as a result of that. Now, there's also growing concern, and this is the latest development just this week, okay, that the way this is going, it could trigger recession in vulnerable economies and possibly further dampen the global economy this year. Now, in response to what we saw in 2020, that the pandemic, our FMBA consult developed this particular slide that I have on the screen. And then we put in there what we saw as major global disruptions up to date. So there are two of them, that's two slides, okay? Ukraine war is still on. Then, of course, the more recent invasion of Venezuela, where we also pointed the satellite on the fact that Venezuela had the largest oil reserve in the world. It accounts for about 25% of the total oil reserve in the entire world. And of course, what happened there also triggered a thought. Is there a possibility that will be right? And of course, economically rewarding. Because Trump said at some point that now we are having Venezuela under our armpit. Any barrel of crude oil that is sold from Venezuela, we are going to split the money into two, right down the middle. 50% for Venezuela, 50% for the US. And nobody responded. Okay? Macroeconomic instability. Again, I host spoke to that in his opening remarks. Social divisiveness. If by today you don't have social media risk on your risk register, then you are not interpreting what is happening globally correctly. Because this came into discussion for us in BA Consult in March 2023, when Silicon Valley Bank collapsed. And of course, we analyzed what led to that. And we took a position that, look, clearly, every organization now should be conscious of social media risk and therefore have a strategy for dealing with that. Of course, we know what is happening to AI. And of course, the most interesting recently is that you ask directors a question. Do you need AI? They say yes. We go, why do you need AI? We don't know. And then, when do we need AI? We need it now. But they have not answered the question, why do we need AI? Of course, AI has four perspectives. You can use it for descriptive purposes, diagnostic, predictive, or prescriptive. The war in Iran, of course, is ongoing, and we know what is happening there. Geopolitics, extreme weather, that's climate change. Of course, we saw that also in September 2023, where the Indian government then, with country with the most population in the world, because June that year, India overtook China and became the most populated country in the world. But in September 23, the Indian government placed a restriction on the export of non-basmati rice. And they said, because of the heavy monsoon rains, that of course affected a lot of rice plantations, if their people were not going to suffer food insecurity, they needed to move on and ensure that they protected what they were producing. So let's keep every non-basmati rice, every grain of non-basmati rice for Indians, no export. And they maintained that for a couple of months before the situation stabilized, and then they reversed it. BRICS Plus, they are meeting this week in Brazil. And of course, we know what that means. All their finance ministers are meeting in Brazil this week. Okay? And of course, conversation is ongoing as well on that. Energy transition, political volatility. So now, the key empowering thing here for you is how do we interpret disruptions? And how do we respond? Because that's what something wants to take away from this conversation. Now, what I did was to take the ongoing war in Iran, where, let's say, suspended, but there are still skirmishes here and there anyway. Countries fell into four groupings. Group one, that's the green, quadrant here. Those that have strong buffers, that are also independent. Independent in the sense that they don't depend on importation of crude oil, number one. They don't depend heavily on importation of refined petroleum products. They don't depend on importation of LNG. They don't depend heavily on importation of fertilizers. The four major things disrupted by that war going on in the Gulf. And so any country that passes those tests will be one we say is resilient. But any country that has weak buffers, but is independent, is still to some extent resilient, but its weak buffers will be a challenge. You have to look out for how do we deal with this, okay? Then a country with strong buffers, but that depends on importation of these items like Japan, that depends on importation of energy products up to 90% from the Middle East. And then you take also South Korea, that depends on that to the extent of about 70%. And they'll come to other countries like Philippines, Indonesia, and so on and so forth. Okay. Sri Lanka, in fact, is in the worst position because Sri Lanka has been struggling with the crisis of 2022 and is just about to get out of that when this this particular war began. Their buffers, that's external reserves, compared to their monthly import bill, is less than 3 months, which of course means they're highly vulnerable according to IMF standards. You need minimum of 3 months cover for you to say, okay, you are at a fairly, passable situation. But when you have that in multiples, IMF will reckon that you have strong buffers. Egypt, for example, with 7 months cover, has very strong buffers. Of course, South Africa also has very strong buffers. It is something $1 billion of external reserves, but it also has challenges with its external obligations that will mature this year, similarly with Egypt. Okay, so when you interpret all of this, that's why I'm mentioning these different countries. So when we're interpreting data for Nigeria, then we can put it in proper perspective. So now, what you want to then do is establish which of these 4 windows your country, at times you call it geography, or your own organization falls into. That will help you determine the extent of your vulnerability. And when you determine that, you then have to say, what are the options available to us? Philippines said, his government said, look, ladies and gentlemen, if you don't need to make a trip, stay at home. That's number 1 recommendation by the Philippines government in response to what is going on now. Then secondly, if you people are going to work, please share vehicles. So instead of putting 4 vehicles on the road, the 4 of you can share one to work. So you save on fare. Then number 3, you don't need to put on the light everywhere in your house. Turn off the light in spaces you are not in. Put on the light only in the space you are in. Now, this is government putting out advice that people on their own should have taken. But officially, the government is putting that out. Now, in some other countries, what the government is doing is providing subsidy. Germany just announced one that is going to do, and they valued at about 5 billion euro, something like that. I came across that yesterday. Now, among these options, choose the best, not minding the inconvenience, and that's what the connection to reforms we bring here. But of course, be quick on execution. So now, what are the economic and market realities of Nigeria? Between June 2023, after President Tinubu was sworn into office, and May, that is as at yesterday, end of business. Because that's the data I have in my slides here. So what were those reforms? Of course, Dr. Chimudia mentioned some of them earlier on. But what I did is to have them summarized here in just one slide, the major ones. Eliminate strange arbitrage around triple opportunity in the FX market. First of the removal, of course, that was a crippling annual waste of $10.7 billion for Nigeria. Fiscal consolidation, broad linkages, deploy technology, make government-owned enterprises more accountable. Tax reforms, we know the 4 tax acts are already in place, the NTA, the NTAA, and of course the administrative and the rest of them. Business environment, rule of law, access to capital, level playing ground, institutions, either they did not exist or they existed before and they became moribund, like the Nigerian Education Loan Fund. It existed in our own days in the university in the 1970s. Our student loans board, but it simply became moribund. But now brought back and renamed as Nigerian Education Loan Fund, but better structured now than in our own time. At our time, many of us didn't really need the loan, but we took it. So the popular thing then was to buy power bikes, among undergraduates there. You buy power bikes, you buy heavy, sound system that will make the, hall of residence shake when you turn on your sound system. Who will bring the, loudest shaking? All right. That was the pattern. But now it's more structured in terms of repayment and even the realities of life currently. Consumer Credit Corporation. When Dr. Adedipe mentioned earlier, introducing me, that I served in the FSS 2020 project of the Central Bank. My firm, BA Consult, was actually one of the 12 consultants that the CBN and other regulators in financial services hired to work on that project. and our own lot was credit market, which was the central thing for that particular program. And the idea was that how do we restructure the credit market in Nigeria to help it drive growth of the economy to $963 billion GDP by year 2020. So our work was central to FSS 2020. And so I said, the way we do it is we democratize credit in Nigeria. That is, make credit available, make it accessible, and make it affordable. But the major thing was credit guarantee. So we said, okay, now what this government has done as part of the reforms was to create a consumer credit corporation. Now, Nigeria launched the first consumer credit policy in 2007. That was done by President Obasanjo. In fact, that was my first official visit to Asoro of the seat of government in Nigeria. That was in 2007. He launched it before he left office. Okay, but Nigeria did nothing about it until the current reforms, where there's now an institution created around that to drive consumer credit. The same thing, Nigeria Credit Guarantee Company, of course, Bank of Agriculture revitalized and of course recapitalized with 1.5 trillion naira. That same convention is ongoing now for development finance institutions, banks like the BOI, Development Bank of Nigeria, Nexim, and the likes. So they're also going to be recapitalized. So, of course, oil and gas, minimum wage, crude for naira, electricity policy, local government financial autonomy, all of these are issues. But what are the global high points? I summarize them here for you. But the key thing here is that this development caused by the war in the Gulf may likely affect economic growth this year. Of course, IMF and World Bank in their April 2026 outlook dampened the projection of global economic growth this year from 3.4 to 3.1%. So what does the data say about Nigeria? And it's very, very important. What does it say about Nigeria? Number one, we can see the equities market, okay, how it behaved between May 2023 and May 2026. That's exactly 3 years, all right? How has the market behaved? Of course, we've seen a bull run that began then, and the market, of course, we say, has responded to the wave of market reforms and macroeconomic research initiated by the Tinubu administration. What are the numbers looking like? Index year-to-date return, end of 2022, 19.98. As at May 2023, 8.82. End of 2023, 45.9. End of 24, 37.65. End of 25, 51.19. As at yesterday, ladies and gentlemen, yesterday afternoon, slope evening, it was 60.96%. And of course, compared to what has happened between reforms that began end of May 2023 and today. In fact, the date should be, I will check this date before this is shared with you. It should be today's date, Tuesday. Okay, sorry, yesterday is correct. But it should be May, not 11th April. Monday, 11th of May, 2026. If you check the movement in the AGX index, it was 334.43%. And I will tell you why I put this out. Of course, market caps, equities only, 413.69%. The reason was because when we came up with FSS 2020, it was in response to the publication by Goldman Sachs about the 4 original members of BRICS, that's Brazil, Russia, India, and China. Goldman Sachs wrote a paper on in year 2000, probably 2001, that they've identified those 4 countries as the new building block for the global economy, and that by year 2050, going to be the first half of the first century of the new millennium, that those 4 economies would have become so important that combined, they will be bigger in terms of GDP than the G7. So, which in turn, of course, led to talking about next level. Next level means the first level will be G7 plus BRICS. Then the next level, that was where Nigeria's name came up. It was in that second, the sequel to that, that we now derived the vision of FSS 2020, which, ladies and gentlemen, is owned 100% by Professor Soludo, because I was there, so I know. Okay? But look at the stock markets of these 4 countries that led into the talking about the BRICS and then the next level. Brazilian Bovespa, the index turned in 73% between December 2000 and December 2004. Russian MUEX, 103%. International Stock Exchange, 65%. Chinese MSCI, 190%. None of them over that period of their reforms and the impact on the stock market, okay, matches what Nigeria has seen in the last 3 years. That's the point we made in that slide. So if you invest, like I said last year, and your portfolio mimic the market, you must have achieved 1.2%. But assuming you did a similar thing this year, between January and yesterday, close of the market, your return would have been 60.96%. That is quite huge. What I also did in working on this was to look back at which stock markets in 2025 were the leaders. Generally, of course, US markets dampened, and so the Europeans topped them. There's particular stocks in Europe, which I marked out here. Greece was the highest return in last year, and the reason was because the economy was recovering, and they did reforms of the banking sector in Greece. So it turned in 60.0% year-to-end return. Czech Republic, 53.4%, due to recovery and growth in Central and East African European markets. Poland followed the 48.4%, economic improvements and investor sentiment. Hungary, 46.7%, increased and positive market sentiment. Japan, of course, I brought in Japan and US because they are the traditional old and strong markets that always showed up in the top 10. The one they did do last year, Japan brought in 26%, again driven by economic growth, corporate governance reforms, and market sentiment. In US, they turned only 16%, okay, yet to end return because of lower energy cost, lower interest rates, inflation stabilized in the US, and of course, there was AI augmented earnings growth. Those are the drivers of the market. Now, look at all these drivers and ask yourself, how many of these elements are ticked by Nigeria? I now added something here as well. What has happened in the fixed income security space, first quarter of this year? That space was driven by sustained system liquidity, large fixed income maturities, continued disinflation, which Dr. Jumedia mentioned earlier, and of course, the 50 basis points cut in the NPR by central bank. Now, liquidity averaged 2.94 trillion naira in February on the back of 4.25 trillion inflows from OMO and Treasury securities, and of course, coupon payments. Now, the expectation this year, and this came at a function like this that I spoke out for Stanbic when we did this in January. Of course, for Stanbic, we went to different locations. We did it, in fact, 5 times for their clients variously, across pension, asset management, and the rest of them. And we identified then that there are 3 African countries in 2026 that have room for monetary easing. That means they have room for their central or reserve banks to reduce the policy rate. Nigeria is one of the 3. Okay. So now, what you see happening in fixed income securities market is that a number of market participants, investors especially, are projecting forward that if monetary easing actually happens in Nigeria and CBN drop the NPR further, how will that affect the prices and the yields on this instrument? So most of them now, therefore, piled into treasury bills. You will see that later. In fact, it's even here, where the subscription to offer ratio was 3.86%. 3.86 times. And that's quite huge. Okay. Now, if you look at rates, that is real estate. Very interesting space also. Very, very interesting. It had a very strong performance in first quarter of this year, with average NAV growing by 28%. Why was that so? Rental escalations, positive asset revaluations, and strategic acquisitions in logistics and office subsectors. Let me give you just a hint. A friend sent me a message 2 weeks ago and said, please, if you find anyone interested in acquiring warehouse along Apapa to the expressway, you can introduce them to us and we arrange a commission. I said, okay, can you share the information with me? Next thing was the video and then the valuation, 50 billion naira. And of course, when I saw the expanse also, in my mind, I was almost like, where along that expressway would this sort of thing exist? So, but of course, I can also tell you for free that there's a whole lot happening in the warehousing space in Nigeria. So the promise of inflation hedge and return stability has driven investors, both institutional and private, into this particular sector. And of course, responding as well to higher occupancy rates and inflation-linked lease adjustment. So what did the economy look like end of 2024? I call this my macroeconomic dashboard, okay? Where you see GDP growth rate, exchange rate official, compare the exchange rate parallel market, monetary policy rate fixed by the central bank, oil production, what is the reality, the oil price, what is the actual oil price as per the records of Central Bank of Nigeria, which is the banker to federal government. So I rely on the price that Central Bank pushed out, because that's the reality of what Nigeria earned. That's what it showed, 31st December 24. What was the position of capital importation? What was inflation rate? As Dr. Ejumade mentioned earlier on, 2024, inflation in December was 34.8%. Now, what was the stock index? Market capitalization, FX results. The figure you see here is a 30-day moving average, which is what Central Bank publishes. They began in 2011, but I won't go into the story behind that, okay? But what we do in BA Consult is, we know external results in Nigeria has two components. There's the liquid portion and then the block portion. So after seeing the bulk figure, which is shown on this screen, we then look at the portion that is liquid and then go to the data on our imports. How much in real time did we import? Actual data per month, okay? We take that monthly import bill and use it to divide the liquid portion of external reserves. Whatever we get now comes a number of months covered. So that's where we were at end of 24. That changed at end of 2025. You can see exchange rates, the premium narrowed, okay? Policy rate dropped, inflation rate came down, capital importation increased, oil price also improved, oil production improved, market stock equity markets indices improved, foreign reserves improved, months of cover improved, end of 2025. What has it been like since January this year up to end of business yesterday? That's what we see here. Exchange rates improved further. Appreciation in the official market 4.56% so far this year. Parallel market appreciation so far this year 6.43%. Of course, monetary policy rate 26.5, inflation rate 15.38, like Dr. Ejumade also said earlier on, kicked up in March in response to what is the Gulf War, so to say. What was the price as at yesterday from CBN? The price for Nigeria's crude oil, $110.27 per barrel. Now, what are the equity market realities? You also see that end of business yesterday. What was the latest available data on external results? 48.36% gross. Liquid portion divided by monthly import bills produced 12.19 months cover. Now, the IMF and World Bank reckon EG to be strong in terms of cover. That's the buffer, with 7 months cover. So if Nigeria has 12.19 months cover, what then we say about Nigeria? Okay. So let's now put it together so that I can wrap up, then we take questions and comments. What I use this chart to show people is to understand that as a professional portfolio manager, whatever your job is, business leader, business manager, you don't make strategic choices based on what data is saying today or what the data said yesterday. You take proper look at trends. And then when you look at trends, you get a better understanding about what is happening to that particular metric. Now, the economy has been growing, yes. That's the reality we see here. We can see the dampening of 2016 when it went into recession. Again in 2020, we know the reasons for those two recessions, but also we see the trend line is trending upwards, which means the growth rate is upwards. But we know where the challenge is, all right? The challenge is to convert this growth into impact on demand on the street. And of course, I also remind people, I'm not a politician, I'm simply an analyst. So when people say that there's no trickle down, I just laugh at them. No trickle down? How do you mean no trickle down? Are you telling me that the student loans board is not trickle down? Are you telling me that the roads that have been reconstructed is not trickle down? You don't pass on those roads. Are you telling me, for example, that our airports are not better today than they were 10 years ago? Okay. And personally, I can't forget the day rain beat me so well at Port Harcourt Airport. We landed, rain was heavy, no terminal building. We're under canopy, rain beat me very well. But now we're going to Port Harcourt, a nice terminal building. So that's a personal experience, okay? So for me, I look at areas of improvement, and that's where I'm going to conclude later. The economy is diversified. I developed this pie chart sometime in 2015, that was 11 years ago, to demonstrate to our National Assembly members that the Nigerian economy is diversified. That's not the problem of the economy. Now, if you look at the data, this data came from the National Bureau of Statistics. It shows you that in general, there are 43 activity groups in Nigeria. If you aggregate into 19 sectors like they did, then you can produce this pie chart. So I update this every quarter when the data on our GDP comes out. It shows you that the economy is diversified. That's not where the problem is. The problem is the external sector of the Nigerian economy is not diversified. We are dependent on crude oil, associated gas, and condensate for most of our foreign earnings for decades. I mean, you can imagine the UK government invited me 22 years ago, that was in June 2004, to come present the paper at the conference in London on the impact of oil on Nigeria's economic policy since independence. So in which case, come and do a paper for us at the conference in London on how oil has impacted economic policy in Nigeria since 1960 up until June 2004. That's 22 years ago. So if everybody around the world that is interested in Nigeria knows that that is a headache for you, so why are we looking at it, interpreting it differently? Okay, like I said earlier, look at the trends. Don't stay with a data point. This is the trend of external results from May 23 to May 26. This is the trend of exchange rates, May 23 to May 26. Then crude oil prices from 2014 to March 2026. Later data available on the website of Central Bank of Nigeria. Crude oil production, export, the same thing. How about inflation? I did that from December 2022 to March 2026. Later data available. Maximum lending rate, of course, PMI, Policy Managers Index. Then, of course, the stock market, which I've spoken to earlier on. So now, bringing it home, what can we infer? It is basically the following. The Nigerian equities market, fixed income securities market, the rates, that's real estate, are all driven by strong fundamentals. And then there's also increased participation by domestic and foreign investors. And this is something that, let me give you a quick illustration of that. Now, we interviewed a fellow for the job of MD of an investment banking firm, okay, of a particular group. And that was on Thursday. And the fellow mentioned some foreign investors that have a meeting scheduled with him to discuss where they can put about $10 billion in this system. And then I was in church on Sunday, 2 days ago, after church service. One of our members just greeted me, okay. The wife said, oh, thank you, sir, for praying for me, because she was going to speak at an international event, brought it to my attention. And I prayed for her that God will give her a word to speak and give her a voice. So she's a professional in aviation industry. So she came with the husband. The husband now said, sir, I'm also, going into a meeting today. I will tell you how it shapes out. So very foreign investors came into Nigeria and they want to have a discussion with me on where to invest. Now that's within the space of 4 days. Apart from we also in BA Consult and many other firms having inquiries. So there's increased participation, earnings momentum, investor confidence inducing reforms. And of course, the system is robust with liquidity. You can't take it beyond the recent banking recapitalization, where 3.374 trillion naira, or 72.55% of the fresh cash injection in Nigerian banking came from local investors, ladies and gentlemen. And of course, I mentioned the space for monetary easing. So in terms of economic outlook, don't do any, ask yourself, well, how do we interpret what is going on? I've made it simple here, just one slide. Tinubu's government has a renewed hope development plan for year 2026, this year, up until year 2030. And what they said they will do is deepen reforms and transformation, diversify the economy, deepen industrial manufacturing, work on revenue and fiscal reforms, strengthen monetary policy and exchange rate management, also focus on capital market development, and then lastly on job creation and poverty reduction, which means do all of this, bring it up to job creation and poverty reduction. Which sectors will they focus on? They are also very clear. energy, agriculture, manufacturing, trade, innovation, digital economy. What are the expectations this year for the economy of Nigeria? World Bank IMF, beginning of the year, said 4.4. April this year, they dampened it to 4.1 as a result of the Gulf War. Federal government of Nigeria expects the economy to grow by 4.78%. Central Bank of Nigeria, 4.49. BA Consult, 4.51. NESG, 5.5, and several others. But one thing is clear. Everyone is seeing this economy growing stronger this year than it did last year. So as a portfolio manager, what are the generic strategic direction? Forecasting has become inadequate in a banning world. So what you should begin to do and focus more on is scenario planning. So you need to develop strategic initiatives for each of the scenarios here. Some people even do up to 5, 6 scenarios. It depends on how you want to pay and analyze the economy. Then this is a time where cash is king. So you must reinvest your liquidity and stress test your revenue. Now, when the times are challenging, you don't invest in large capital expenditure projects, okay? But you also as well complement that by streamlining your OPEX. Then this is a time to automate every amenable process, digital first, and of course, communicate and engage. Now, there are 5 popular strategic initiatives that investors can adopt to effectively manage stock market risks, and none of them is mutually exclusive of the others. Dr. Ejimede again earlier mentioned that in his opening remarks. Portfolio diversification. Of course, portfolio rebalancing must be an ongoing thing. I mean, I do this on an ongoing basis for clients because I sit as chairman of the board of an asset management company, and I also chair as an independent member the investment committees of 2 other asset management companies. Then I consult for perhaps what you may say the biggest of them. I do this for them. What I'm doing here, I do for them. Okay? So it then means rebalancing is an ongoing thing you do. Then you must develop long-term perspective, which means you don't go and make decisions based on, oh, the market dampened this week. Like it happened in February this year, you know, when the new tax act was now being discussed and the market participants missing capital gains tax, which of course was to align that capital gains tax in Nigeria with the best global practice. That's all we did. But when market participants now understood that, the market dampening revived and the market continued to grow. Research and analysis, like something is doing, and of course, what they also are stating on this platform, stop loss and risk limits. Then, of course, for international investors, international diversification, because US markets are not as hot as they were historically. I mentioned that earlier on. Focus on structural winners, embrace sector rotation, monitor emerging markets. Then, of course, these are tactical issues. You can read them later. But I gave an illustration of how diversification can bring more value into your hand. So which means, in fact, this was developed when I was invited by the CIS Academy, that's Chartered Institute of Stockbrokers Academy, about 3-4 weeks ago, to interrogate the Nigerian stock market and now see whether this bull run has gotten to a point where the market is too hot to be sustained and there could be a correction. So now in looking at that, I now also said, even if there's that thinking, you want to ensure you don't lose out at both ends. Maybe you think the market will soften now, but the market continues on the bullish run. So how do you ensure you don't lose out? That's the essence of this illustration. And of course, you can also diversify with a basket of commodities, as I mentioned earlier on. So summary and conclusion. Now, the Nigerian economy and the war in Iran. The saving grace for the Nigerian economy, what I call resilience factors, include the following. The bouquet of reforms since May 2023, they have been sustained because not any single one of them has been reversed. In fact, only last week in Paris, the Minister of Finance and Coordination of the Economy, Oyedele, made a remark that was in the news everywhere, that oil subsidy removal, Nigeria is not going to reverse it. And that's a very good one because, like we say in market interpretation, we also look out for significant utterances of key government functionaries. And of course, what I was said last week, I told myself, this man understands this factor. It's a key factor in movements of exchange rates, movement of interest rates, and now investors, local and international, will respond to your geography. Okay? Secondly, domestic refining capacity. In fact, what I told an audience last week was that God help Nigeria that Dangote refinery is already operating. If this crisis happened when the Dangote refinery was not in operation, the impact of the Gulf War in Nigeria would have been more deeper. In fact, we'll be discussing this matter today. We're talking about everybody looking for a way out. Crisis, serious one. Okay. There's also growing supply of fertilizers to the global markets. Nigeria accounted for a little less than 1% of the share in 2024 of the global fertilizers market. The projections everywhere in the world you talk about fertilizer is that Nigeria will become a major player in 2024. I was in a team that went on tour of the Dangote complex about 4 weeks ago. And then we saw the fertilizer complex, which has, I think, you can say 3 in 1 in terms of the plant. But there's construction work ongoing to triple that. They took us to the space, we saw everything. And I said, if Dangote refinery is producing this number of tons per annum currently, and it wants to triple that, and that will be done by end of 27, early 28. So I could now connect with what is being said globally about Nigeria becoming a major player in fertilizers globally in 2028. Okay? Strong external results, I've explained that earlier on. Stable and appreciating currency, and also the policy guidance for the first time. CBN governor said, ladies and gentlemen, there will be no devaluation in 2026. So you can take that to the bank, all right, as an investor. So let me now see how you respond. In a time of reforms that are addressing crisis, and we are now talking of building resilience, shouldn't you be talking about the same thing for your own organization or institution? That means what we call the bridge of resilience should be redesigned. You look at the maintenance issues in there and the ability of that bridge to withstand turbulence. And that's what it's all about. So it's about resilience and sustainability. So your best bet, as I always say, against rising cost of doing business is to aggressively grow revenue, which means there's a limit to which you can cut cost. Cost becomes an issue. Look more on the side of revenue and grow that. So conclusion, if you can't see and find opportunities where others see trouble, then your lens are weak. I had a similar one that I began with 2 years ago, and I put it this way, that if your mind is trained to see opportunities, you will never surrender to or succumb to problems. So maybe it's just to look at it differently for you as a leader. The final one is this, is credited to an unknown author, but often pointed at Oscar Wilde, who said, everything is going to be fine in the end. Full stop. If it is not fine, comma, then it is not the end. Which means keep doing what Sam Thiel has offered us to do today on an ongoing basis. Interrogate your strategic initiatives, amend, change, render some obsolete, replace, but on an ongoing basis. You don't give up because there's trouble or crisis. The idea is that they bring opportunities. How do we find them? How do we expropriate them? So thank you very much, ladies and gentlemen. At this point, I will now stop sharing my slides. Okay, thank you.
Yes, Prof. Thank you so much for the beautiful insights. I want to speak to the participants at this webinar that you agree with me that Prof has provided valuable insights on the subject matter. I know, particularly highlighting how ongoing global geopolitical tension, could pose some form of challenge to global and domestic growth prospects in the current year. In-house, we initially forecasted a growth rate of about 4.5 for Nigeria in 2026. But when the whole issue of the global geopolitical tension started, we did a reforecast and we did a base case scenario, and we saw a marginal decline of about 4.3. So our own forecast in-house about 4.3, in-house, And in spite of all the issues that is happening, I think the point that Prof also mentioned that is also very important at this webinar is the fact that despite the political tension that we have seen that the Nigerian market has continued to demonstrate resilience, supported by improving macroeconomic indicators that we have seen so far. I think Prof displayed the macroeconomic indicators and where we came from since 2023 and where most of those macroeconomics indicators are at the moment. And we've seen strengthen investors' confidence, in the Nigerian economy. Just recently, we saw the FTSE re-rating of the Nigerian economy, into the emerging market. And all of this is because of the strong fundamentals in terms of the macroeconomic indicators that, they were also seeing and all that. We've also seen renewed activities in the capital market coming from the investors' confidence that we have seen, coming from the improved macroeconomic environment that we have seen. And the capital market, like we have seen so far, has given us a market cap of over 160 trillion and all that. And the ASI has done over 250,000, levels. And just before we get to the end of the year, we've seen the market year to date doing over 60%. That's fantastic, And we've also seen, when Prof also mentioned the fact that there's also increased opportunities, the need for us as investors to think of how we can look at how we can diversify our investments. He did make mention of the equities market. He made mention of the elevated yield in fixed income, which is currently at around 18%. He made mention of the REIT, real estate investment trusts, currently doing about 28%. And of course, I think the point I also talked about is that also has to do with gold. Talking about how gold prices have increased significantly and a lot of opportunities that have also come up across the various sectors. No doubt, it is important that, again, I also know that this discussion has further underscores that Nigeria's ongoing reforms are steadily reshaping the economic and investment landscape. I think at that point, he mentioned that the minister did say that Nigeria is not going to go back in terms of reverting the fuel subsidy that many people have been talking about. And it has also brought diversification across asset class, like I mentioned earlier, including equities, fixed income, rates, commodities, and such as gold. Importantly, I think, again, another part that Prof also mentioned is the adoption of long-term investment strategy rather than short-term. And I think that's very key. The beauty of investment lies in long-term, not in the short-term. And I think it's important that we say this to particularly participants at this investment. And he also then mentioned some approaches that we can use, particularly in times like this when the world is facing global challenges. One of the parts that he mentioned, which is particularly more of interest to me, is the part where he talked about the continuous portfolio rebalancing. Some people at the beginning of this year, we had never thought that the oil and gas sector was going to do so well because we've envisaged that oil prices is going to come even below the budget assumption that we had in our budget. Today, oil prices has gone significantly high. And if you look at the NGS, the sectoral indices in our NGS, that sector has done over 100% year to date. So if you had not done a rebalancing of your portfolio, you will just be remaining, stick to one sector, and that might be causing a lot of issues. He also mentioned the impact of embracing sectoral reform and strong research units, which currently we boast of in Sterling Asset Management and Trustees. Importantly, Prof also emphasized the need for investors and market participants to remain informed. And I think that was the reason why he was displaying the history of all those macroeconomic data that we saw at the beginning. He mentioned that, and adaptable and also proactive in identifying and positioning for opportunities, emerging from the next phase of growth and market. So these are beautiful insights that we got from the presentation of Prof. What we will do now is that we are going to be opening the floor for some questions and answers. So Prof will be providing some answers to some of the questions that we will be seeing. But while we are doing that, there's a poll that we are trying to put up at this, while people are asking questions. We want to appeal to all participants to please just help us fill the poll. It's a very short poll that has about four, 5 questions. Just help us tick it so that it can help us guide, the kind of webinar that will be given to you as our clients, going forward. So I'm going to share the poll right now. and I expect us to click on it so that we don't elapse, we don't use more than the time that we have scheduled for this. So you can, as you're asking your questions, you can also, be taking your time out to fill up the poll. Thank you. So first, I think I'm seeing Olayinka's hands up. Olayinka, you have the floor. You can ask your question. Olayinka Lunge. Can you hear me? Olayinka, you have to unmute yourself so that you can speak. So Olayinka, you can unmute yourself now and speak. Olayinka, can you hear me?
Yes, okay, I can hear you.
Great. So you can ask your question. Thank you so much.
Thank you, Mr. Patrick, and also for Prof. It was quite insightful. Sorry I joined in between because I had some other meetings. So my question is that looking at the stock market, really, at some point you begin to get a bit skeptical that if a market has done year to date almost 60%, and you are beginning to get to a point that you want to trade cautiously so that, when it's falling, you don't now begin to now get the rainfall on you or stuff like that. So for me, I just wanted to know, because you are the expert and you watch this data from back to back. Can we say that the bullish trend or the participation we are seeing in the stock market right now is attributed to just locals, or we are seeing element of FPI participation in them? Because we begin to see the trend that even if you say the market has gotten to its overbought region, but it just keeps going, and then you want to put a pause on maybe your profit and just take your profit and leave and stay on the sideline and then come back. But as you are taking that decision, you are seeing that the same stock that you thought maybe is going to retrace is also still going up. So at what point do you want to make those calls? So that's why I'm just saying, do we really see the FPIs participating more right now, or it's just the locals, or a mixture? Thank you.
Oh, thanks so much, Olayinka, for that question. Prof.
Okay, do you want me to answer that straight away?
I think it's better we take it as it comes,
Okay, all right.
Okay, sir.
Now, very good question, Yinka. Thank you for that. In actual fact, that was the subject of my conversation with our stockbrokers just last month, April. And the focus was, of course, on market consolidation. Consolidation technically means you are faced with the kind of scenario you painted now, where you think perhaps the market has plateaued and that it's unlikely to rise any further. And then just like you said, you discover that the stocks you claim to be consolidated actually started going further up in terms of price increases. So question then is, how do you maximize, what we call consolidation then is a period when the price of an asset moves within a confined range. So, but it's not so. We haven't seen that evidence in the Nigerian stock market in the last 3 years consistently. So now this is what I normally will advise. It is a bit technical in a way, and that is analyzing market consolidation. It's a bit technical because you are looking now at how you determine, number one, that the market itself is consolidated. Then number two, every stock in that market, you now also evaluate it. What is its historical antecedents till date? Can the data on that stock in the last 3 to 5 years give you a pointer that the particular stock in question has actually consolidated, that it's reached a place where there is every sign that it's unlikely to go any further? So when you get to that kind of situation, what we say that it's not about exiting the market entirely, okay? What to do is to safeguard your gains while positioning for sustainable growth. And there are 3 critical things there. Number 1 is discipline. Then number 2 is diversification. And of course, risk management, which means, how do I extract some value from the gains I've seen in the market so far? But how do I also maintain a position to take advantage of further growth in the market? So that is the whole essence of consolidation, which your question is about. And that was why I gave an illustration, even though because of time, I didn't discuss that example, okay, that I gave there. The illustration was that of someone, for example, who at the beginning of 2025 had 10 million naira invested. And now, given how the market performed in 2025, that person gained 52%. So that portfolio now became valued at 15.2 million naira beginning of 2026. We then say, okay, there are 3 things this investor should do. Number 1, take profit of 25%. So 25% of 15.2 million would be 3.8 million. That's profit. So we have taken some gain from the market that has been growing steadily, okay? Then the balance, what remains, rebalance it. Okay, rebalancing can now mean that, okay, maybe this investor are concentrated only on equities. We now say invest also in bonds. Let's say this investor takes 20% of 15.2 million and invest in government bonds or maybe some, private bonds that's issued by corporate entities, and that is 3.04 million naira. So what now remains? Remaining 55%. You now want to hedge that position. How do you do that? Yes, we continue to trade in this market that we are, that is still bullish, okay? But we now introduce a stop loss. And that stop loss will be that if at any point in time this market dampens below 10%, there are some stocks we are going to back out from, okay? We call that a hedging instrument of a stop loss. We call it a trailing stop loss, okay? At a predetermined percentage below the current market value. So when you do that, you are not only rebalancing, but you're also repositioning your portfolio for the bullish market that people are arguing, is it consolidating? But the data is not showing that it's consolidating. So you don't want to lose out at both ends. Take profit from what is happening now, but at the same time, rebalance the portfolio. And after rebalancing, you also now want to put in a kind of hedge. So rebalancing might be what I also mentioned. You invest in commodities, as I explained. Of course, equally, for an investor who was only in equities, you can now also move into bonds, both sovereign and, of course, private. And at the same time, invest in commodities, in gold. Ironically, even the destruction happening now is why the price of crude oil is so high. So you can also trade in that if you have the window for it anyway. Like an inquiry our company got from which country now, Japan some time ago, but recently there's another country that came and said, we're okay, yes, it's from UK. Actually, yes, I remember now. It's UK. And he said, if we can introduce them to the crude oil market and link them up here, that they want to invest. And they were talking about, was it not $5 billion or so? So which again connects to a second part of your question, which is that our FPI is also interested. I can tell you straight away that FPIs are also now more interested in the Nigerian stock market. But the more interesting is that a good number of them are coming as FPIs. Okay, that's from the window of BA only, what I know. And you can imagine what other advisory service firms are experiencing in a situation like this. Okay, so we have a project we are working on now, I think about $500 million that some investors are bringing into a space somewhere in Lagos here. We are writing, as I speak to you, the feasibility study for that to get approval of the federal government for them to invest $500 million. That's FDI anyway. And there are many others like that. So FPIs are coming, FDIs are also coming in their large numbers. So thank you very much for that question. And that's the beauty of questions. They elicit more information. So, Dr.
Prof. Yes, Prof.
I will probably do something. My
Okay.
slide deck for the CIS Academy, because there's no copyright on it, so it's my paper. All right. I'll probably share them with you. So at least people can pick out the snippets on consolidation that I discussed in answering Yinka's question.
Oh, great. That would be nice, Prof. Thank you so much. In addition to what Prof said, yes, thank you, Yinka, for that question. In addition to what Prof said, it's very difficult for you to see that all the stock in the exchange will reach their full potential at the same time. And that is why it is important. Just like you mentioned when you were asking the question, we keep the data. We have the stockbroking and financial advisory unit where we can do some form of research on proper valuation, proper technical analysis for our clients and, both existing and potential clients as to looking at those stocks that have reached their full potential so that even when you are now doing some profit taking from those ones that have reached their full potentials, you will know the ones that have not reached their full potentials that you can then begin to look, to put your investments in. I just needed to say that so that you would get that. Then again, you will see, Prof mentioned it, that we see a lot of FPIs, coming into Nigeria. Again, if you follow the news, you will see the FTSE re-rating of Nigeria into emerging markets, and that has brought some level of significant confidence to the Nigerian markets, and that is attracting significant portfolio investors to the market. If you go through the data, you see that portfolio investors have grown significantly. Another factor that is driving it too is if you look at this liquidity in the system, the banking sector recapitalization that we saw brought in over 4 trillion to the market. And of course, that has improved liquidity in the system. And yes, some investors will want to do some form of bond equity and other form of investment, but the return on the equity market, particularly for some stocks, is high at the moment. So, and that is also bringing some people, some investors to that space, just to add to what Prof said. So thank you so much, Yinka, for that question. Prof, there's a question on the chat box. So I'll just put it to you so that we can then get the response to the person who asked. The person said, in 2008, global meltdown transmitted into the Nigerian equities with a strong foreign indirect portfolio presence then.
Yeah.
In the last 10 months, NGS reports indicated that we now have more local equities investors participation. I think it's similar to the first. In the event of a possible market bubble, how should local retail investors be positioning to minimize the downside? It's similar to what Yinka asked.
Yeah, similar, but it brings an interesting dimension of the GFC, that's the global financial crisis of 2008. Now, the peculiar situation of Nigeria then, vis-a-vis now, is this. At that point in time, Nigeria had also very strong external buffers. Our external reserves we're just coming out of the historical high of external reserves in Nigeria. At that point in time, we had $64 billion. That's the highest ever in Nigeria's economic history. Okay? But between April 2008 and November 2008, Nigeria hemorrhaged for the reason of what this, my friend, mentioned, foreign portfolio investors trooping out. Now, the way central bank approached it was this, and this is why I remember the data vividly. Now, the central bank devalued the naira at the time. Soludo was still the governor of the central bank. And I challenged it. Why should you devalue the naira? Because we had very strong buffers, and I had made an argument before then that the government needed to introduce a safety support to keep our stock market stable. But it was the same Soludo who responded to my recommendation. For the two of us were to speak at a particular seminar organized by the Institute of International Affairs. But he sent one of his deputy governors to represent him. So I now made that remark when the media interviewed me. So Soludo now issued a statement following which I said the Nigerian banking system was very strong and insulated against the global financial crisis, so that it did not need bailout. Otherwise, I mean, rather, it was the banking system that will bail out the economy. That was his response. So when he now devalued the naira, of course, at that time, the naira was about 118 naira to the dollar, and he devalued it to 132 naira to the dollar. And I challenged it. Why devalue? Well, he said about 40 countries around the world, because of GFC, devalued their currency. I said, so must we copy what other countries are doing? So he now brought out the data. And he said, on a monthly basis from April to November of that year, Nigeria was earning about $3 billion inflows, and there were outflows of about $7 billion monthly as a result of what this our friend said, FPIs trooping out. So I did that back of the envelope calculation. That's a net outflow of $4 billion every month. April to November, I quickly checked it. That would mean 8 months. So 8 by 4, that meant $32 billion left the Nigerian stock market within the space of 8 months as a result of this particular, response to GFC. So that was why the market was badly affected in 2008. That's the data behind it, ladies and gentlemen. But also because at that time, we didn't have a clear picture. Don't forget, Obasanjo handed over to Yar'Adua. And of course, Yar'Adua's leadership, although it started well, but the said challenge also was taken note of by both investors locally and foreign. The foreigners are more sensitive to such things. So it's like, look, is there a possibility this man has started reversing some of the reforms Obasanjo did? For example, the sale of the government refineries to Dangote, he reversed it. And of course, people generally were not comfortable when they also sacked Ribadu as chairman of EFCC and a number of other things. So investors became jittery, and that was what happened. But if you look at Nigeria today, it's a different story. Now, you have reforms happening that everybody applauds locally and internationally, but mostly the market, as you said earlier on, is dominated by local investors. So, question, is there a possibility of a meltdown? That's the first question. But what drives meltdown? We've looked at some of the metrics, and we said, looking forward, there is no clear indication of a meltdown as we are. So, but even if that one happens, how do you protect yourself? It goes back again to what I said in my presentation. Okay? And those are that's why I call them the generic response of any investor, whether institutional or private, to such developments. So you need to be very aware of what is happening in the market. Like Dr. Ejumedia said, you must be in tune with the market. Number 2, continually also interrogate all those elements that affect the instruments in your portfolio. Rebalance the portfolio on an ongoing basis. Maybe also take an opportunity that I described. Take some gains and then
Hello, Prof.
yes, thank you.
Okay, great. So we'll take one more question. The essence of this is so that we'll be able to keep to time. We do not plan to exceed the 2 hours that we plan for this meeting. So we'll just take one more question, then we will then see how we can round it up. I saw a question here, Prof, and the person said, thanks for your consistent, insightful delivery. Please, is it because of oil swap that we are not talking of oil windfall while other oil-producing countries are celebrating it?
Yeah.
Secondly, what's your take on the new model with the Chinese
for our
refinery?
Okay. All right. Thank you very much. Very good questions. The first one is whether it is because of the oil swap that we are not, celebrating the windfall that came as a result of the war at the Gulf. You are spot on. Because what Tinubu inherited is a situation where almost every barrel of crude oil we produce has already been committed upfront to extinguish existing obligations that were maturing. And so the only window for his government to make money from oil will be to increase output. And that's why you notice that all the efforts, the executive orders, I think that is 8 and 9 that Tinubu signed in February 2024. And then the recent one is signed, that 9 is the one he signed recently, that this with, NNPC, all of them are aimed at ensuring we create an environment that will attract new investments in that space so that we can produce more. If we produce more, then we have space to do other things beyond what the current production is taking care of, the oil swap. So that essentially is why we are not, dancing to the bank like other, oil producing countries are. But there's something also you don't want to miss out. And this I picked out between Thursday last week and Friday. There was a reversal in the trend with our external reserves, which possibly is explained by this question you raised, that is oil. Because in the last 4 weeks, our external reserve has been going down, although very little anyway, which means we don't have accretion to reserve, but the reserve has been dampening little by little on a daily basis. But between Thursday last week and Friday, it reversed. It started now going up again. So, and I can only put that to what is happening in the oil market. The price of crude oil going up, but also, I would also miss out on the fact that 2 weeks ago, the NNPC announced that there's now an increase in our production, even though I didn't reflect that in my, slides, because CBN is here to publish that data. I always stay with CBN data, okay? But NNPC official report 2 weeks ago indicated that we are now producing more. So that could possibly, with the price of crude oil high up, explain the upturn in our external reserves last week, which is positive. The second one, where the Chinese, incidentally, when it comes to the refineries, personally, I've had a lot of experiences. You consult different companies here and there. Some have been given the contract before for turnaround maintenance. And of course, the client in question at the time, maybe this I'm talking about 21 years ago, I knew quite well that client had no new jack about oil production, but it was given the mandate for turnaround maintenance of one of the refineries. So now, question for us is, do these Chinese have the capacity? Yes, it passes the test. So they have the capacity and they are willing to. Of course, one thing with China is they will fund it, okay? You bring your counterpart funding, and of course, if they will fund it, you can be sure about this also, that the fund will be very, very cheap and affordable. And I'm speaking from experience of being involved with projects. We are from the London, US market. We got all-in cost about 14–15%, and we got it for 4% from China with 3-year moratorium over a 10-year period. 4% of 14 is a big difference in terms of cost. So for me, if the Chinese, of course, those I believe have the competence, the capital that comes second is also within Chinese capacity. I think we may see a change of story with respect to those refineries. I think so. Thank you.
Yes, Prof. Thank you so much for that response. Like we did said earlier, we want to keep to the time that we are scheduled for this meeting. Because of that, what we will do is that if you have further questions to ask, you can share the questions with us. We would ensure that we send the questions to Prof, get his response, and then send it to you via the platform that you would have used to send us the mail. You can reach us via any of our platforms, social medias, WhatsApp, so that we can get your question. So first, let me appreciate my MD who is on this call for giving me the opportunity to anchor this event. My MD, Mr. Omayebu, I want to say thank you for giving me that opportunity. And then I want to, on behalf of SAMSU, I want to sincerely appreciate our distinguished speaker, that's Professor Abiodun Adedipe, for sharing his valuable insights, expertise, and perspective during the webinar. Your contribution have made this session highly enriched and impactful, like we have seen in the comment section. We've seen a lot of comments about how insightful the webinar has been to participants. I would also like to thank all our participants, our clients, our partners, and stakeholders who took time to join us today. Your engagement, the questions that we have seen, even though they are few, have contributed greatly in enhancing the quality of this discussion. We truly appreciate your continued support and participation, and we look forward to having you join us again whenever we are having a session of this nature. Please, I want to also say that if you have not filled the poll, that's the survey poll that we are doing, you can take time out to ensure that we fill it. We need your response to be able to plan, going forward. Before we close, I would like to briefly highlight that the webinar is part of a broader series of knowledge sharing and market engagement initiated by SAM2. I did say this earlier, that SAM2 is an asset management company that has subsidiaries that cut across asset and fund management, trusteeship, registrar, advisory, and stockbroking. So you can reach any of our subsidiaries, if you have business opportunities, or you want to involve in stock, you want to get into the fixed income instruments that you will, so any of them, you can reach any of our subsidiaries via their handles, social media handles. We look forward to engaging you. We look forward to engaging you in our upcoming webinars and research engagement. This is the first for the year. Others will be coming up, so we look forward to engaging you as this unfold. And as we formally bring this session to close, I would like to sincerely thank you all for your time, participation, and valuable contribution throughout the session today. We hope that the insights shared have been helpful in deepening our understanding of the evolving economic landscape and the strategies required to position our portfolios for the next phase of growth. Once again, on behalf of SAM2, we truly appreciate your engagement and look forward to continuing this conversation in our future session. Thank you, and have a great day ahead. Thank you.
Thank you very much.
Yes, Prof.
I appreciate it.
Yes, sir.